Welcome to this session on the Introduction to Accounting, part of our APFC and EPFO exam preparation series. In this video, we'll build the basics from the ground up. Let's start with the definition. Accounting means keeping a systematic record of money-related transactions and using those records to understand the financial position and performance of a business. Think of Rahul, who starts a small business. He invests 1 lakh rupees, buys goods, sells goods, pays rent, and receives money from customers. That's a lot of events happening. If Rahul just tries to remember all this, he'll get confused. Accounting gives him a systematic way to track every transaction.
Here's a simple question. Suppose you start a business with 5 lakh rupees, and after a year, you have 6 lakh in your bank account. Can you say you made a 1 lakh profit? Not necessarily. Maybe 2 lakh was a bank loan. Maybe some of your sales haven't been paid yet. Just looking at cash isn't enough. Accounting helps us answer the real questions: what the business owns, what it owes, its revenue, expenses, and profit or loss. That's why accounting is often called the language of business.
A transaction is an economic event that can be measured in money and affects the financial position of the business. For example, purchasing furniture for 20,000 rupees is a transaction. Furniture is acquired, money is paid, and it's measurable. But if someone just says, "I'm planning to buy a computer next month," that is not a transaction because nothing has actually happened yet. Remember this for the exam. A mere plan or intention is never a transaction. Accounting doesn't record every single event in a business. It only records events that have a financial impact and can be measured reliably in money. For instance, if a company hires a very talented manager, that's important, but can we say the manager is worth 10 lakh rupees? Not reliably. So this isn't recorded as a normal accounting transaction, even though it matters to the business.
The accounting process follows a clear sequence: identify, measure, record, classify, summarize, analyze, and communicate. We identify a transaction, measure its value in rupees, record it in the books, classify it with similar transactions, summarize everything into financial statements, analyze what the numbers mean, and finally communicate that information to the people who need it. Bookkeeping is mainly about recording transactions, just noting down the figures. Accounting is much broader. It includes recording, classifying, summarizing, analyzing, interpreting, and communicating. So bookkeeping is really just one part of accounting. Accounting is the bigger picture. Accountancy is the theory, the subject itself, with its principles and rules. Accounting is the practice, actually applying those rules. For example, knowing the rules of debit and credit is accountancy. Actually passing a journal entry using those rules is accounting. Accounting information isn't just for accountants. Owners want to know if they're making a profit. Management wants to know where costs are rising. Banks want to know if a business can repay a loan. Suppliers want to know if they'll get paid. The government uses it for taxation, and employees care about it because it affects their job security and salary. Accounting serves 2 main purposes. First, measuring performance, telling us if the business made a profit or a loss, shown through the profit and loss statement. Second, measuring financial position, telling us what the business owns and owes at a point in time, shown through the balance sheet. Remember this clearly. Profit and loss is about performance over a period, while the balance sheet is about position at a specific point in time.
Let's put it all together with Amit's stationery shop. He puts in 1 lakh rupees as capital. He buys furniture worth 20,000, that's an asset. He buys stationery goods for 40,000, that becomes inventory. He sells goods for 30,000, that's revenue, and he pays 5,000 as rent, that's an expense. Once these are processed, they reveal Amit's profit and his financial position. Here's the full journey a transaction takes. It starts as a business transaction, supported by a source document, like an invoice. It's recorded in the journal, classified into the ledger, summarized in the trial balance, and finally appears in the financial statements, which are then analyzed and interpreted. 4 words to lock into memory: transaction, account, accounting, and accountancy. A transaction is the event itself, say buying furniture. An account is the record for that item, like the furniture account. Accounting is the process of handling that transaction, and accountancy is the set of rules that governs how it should be done.
Let's do a quick revision for the exam. If asked what accounting is a process of, remember identify, measure, record, classify, summarize, analyze, and communicate. If asked what bookkeeping is, it's primarily recording. If asked whether accounting is broader than bookkeeping, that's true. And if asked the main objective of accounting, it's to provide useful financial information for decision-making and to determine performance and position.